Welcome to the deep dive. Today, we've got a pretty vital mission, actually. We're aiming to cut through all the noise, really complex global news. Trade wars, currency shifts, tech geopolitics, and boil it down to the four most critical insights you need from the recent news cycle.
Yeah, we've waded through a lot of dense source material for this one. We're hitting four key events. There's a big strategic concession from China, a really interesting lesson from how the yen and the Swiss franc are behaving, like a 48-hour semiconductor drama out of Taiwan, and then this new U.S. tariff strategy that looks pretty aggressive. We'll try to break it all down, maybe use some analogies to make it stick, especially if you're newer to this stuff.
Okay, sounds less like a deep dive and more like an emergency portfolio briefing. Let's jump in. So first up, this move by China, giving up a major economic advantage. That sounds big.
It was huge, a massive pivot, really.
Yeah.
Just recently, the Chinese Premier Li Qiang, he announced at the UN that China will stop demanding special and differential treatments, SDT, in future WTO talks.
Okay, SDT. For those of us, myself included, who aren't exactly WTO rulebook experts, what is that? What does it mean in practice?
Right. Think of SDT as like a set of training wheels or maybe a handicapped in trade negotiations reserved for developing countries. It covers roughly 150 different perks, things like being allowed to keep higher import taxes, offer bigger subsidies to their own companies, and they get more time, often years more, to implement new global trade rules. China's held on to these for decades, despite being, the world's second biggest economy.
So giving that up, that sounds like a serious financial hit. Why give up perks that shield your industry?
That's the really clever part, the strategic calculation.
Yeah.
They give up the perks, the economic stuff, but they fought hard, really insisted on keeping the status. They still call themselves the world's largest developing country, and maybe even more importantly, the leader of the global south. So they're trading an economic shield for, diplomatic clout.
But what does being leader of the global south actually do? Is that just a fancy title?
Oh, it's much more than a title. It gives them huge political leverage in places like the UN, the WTO. It means votes, influence, especially over other emerging markets. China basically decided that headache of constantly fighting the U.S. over the SDT perks, it just wasn't worth it anymore. The diplomatic leadership role became more valuable.
And the timing. Why do this right now? Just before that big U.S. China summit at APEC in October.
Well, it feels like a classic pre-negotiation tactic, doesn't it? The Trump administration has hammered China on using SDT for years, calling it totally unfair. So by taking it off the table themselves before the summit, bam, they remove the other side's favorite talking point. It's smart.
Yeah, it completely changes the dynamic before they even sit down. And it makes them look like the responsible ones championing free trade.
Exactly. They position themselves as a responsible major power, which, contrasts nicely with some of the protectionist trends we're seeing elsewhere. And the WTO Director General immediately praised the move. So, yeah, it played really well internationally.
So what does this mean for markets right now? Any immediate impact?
In the short term, maybe a little less anxiety. It dials down what analysts call G2 risk, that constant tension between the U.S. and China that hangs over markets. So a small sigh of relief. But long term, this could really shake things up in China's markets. Our sources use this phrase, accelerating the sifting of the gold from the sand.
Sifting the gold from the sand. I like that. Explain that.
Without that SDT safety net, those Chinese companies that really leaned on government help, like subsidies or high tariffs protecting them, they're going to struggle. Only the ones that are truly innovative, truly competitive on a global scale will likely thrive. So for investors, it means you have to be way more selective. Look for the companies that can stand on their own 2 feet.
That idea, structural strength, actually leads us perfectly into our next topic. It's a currency puzzle. The Japanese yen versus the Swiss franc.
Yes, this is such a great illustration. It really teaches a core lesson for anyone investing globally. The currency's long-term value isn't just about its interest rate today. It's like the country's overall report card. Its fundamental health.
Okay, why Japan and Switzerland? What makes them such a good comparison here?
Because on the surface, their monetary policies looked kind of similar recently. In September, both the Bank of Japan, the BOJ, and the Swiss National Bank, the SMB, they basically kept their interest rates steady. Switzerland's rate is still technically 0, which is actually lower than Japan's 0.5% ceiling. But the franc is super strong, historically strong, while the yen is famously weak. So what gives?
Right. If the rates are close, what explains that huge difference?
It comes down to the stance, the commitment. The Bank of Japan stayed dovish. That means they're signaling they prioritize economic growth, even if it means a weaker yen. They kind of disappointed folks who were hoping they'd get more aggressive, tighten things up.
And the Swiss, they went the other way.
Completely the opposite. The S&B doubled down on its hawkish commitment. They're very clear. They stand ready to intervene to prevent the franc from getting weaker. Why? Because Switzerland imports a lot. A weak franc means painful inflation from those imports. So their priority is price stability, and they'll fight the market if needed.
So policy commitment is huge. But you also mentioned the economy's report card. What are the fundamental grades for these two?
Well, Japan has this underlying structural weakness. Even now, something like 16% of its imports are energy, mostly fossil fuels. So when oil or gas prices shoot up, Japan gets hit hard. Trade deficits widen, the yen weakens. It's their Achilles heel, you could say.
In Switzerland, what are they selling that makes their economy and their currency so much stronger?
They're basically exporting stability and high value. Over half their exports are things like pharmaceuticals, chemicals, stuff that's not very sensitive to price changes. Plus, luxury watches, about 7% of exports. People buy those things, a fancy watch or a critical medicine, almost regardless of the price or the exchange rate. They sell unique, quality, irreplaceable goods. That's their strength.
Okay, so the lesson seems clear. Invest in companies that sell that unique, irreplaceable stuff, the ones with pricing power, as you called it.
Exactly. Pricing power is key. Think about a high-end German car maker or, like you said, a Swiss pharma company. They can handle shocks like tariffs or energy price hikes because they can just pass those costs on to their customers who will still buy the product. Those kinds of companies are a much safer bet in volatile times.
And beyond specific companies, what about diversifying where you invest?
Yeah, definitely look beyond just the big G7 economies. Our sources talk about these strong, small nations, like Switzerland, Singapore, the Netherlands, countries with really specialized industries, strong finances, global importance despite their size. They offer a different kind of stability.
Okay, from the long-term strength of the franc, let's shift gears completely to a moment of sudden, high-stakes drama. Taiwan briefly trying to use its dominance in semiconductors as a weapon. The sources are calling it the Silicon Sword experiment.
Yeah, it was quite startling. For years, everyone talked about Taiwan's chip industry, especially TSMC, as its silicon shield. The idea being that it's so critical to the global economy, no one could afford to attack Taiwan. But last week, they seemed to try using it offensively.
What exactly happened? What triggered it?
So on September 23rd, Taiwan announced export controls. It was basically almost a ban on 47 specific semiconductor items going to South Africa. And the reason? Purely diplomatic payback. South Africa, apparently under pressure from China, had downgraded the official name of Taiwan's diplomatic office there.
Wow. Using vital chips as like diplomatic ammo? That
Yeah.
feels like a really big step, a major escalation.
It was instantly called the first real use of the Silicon Sword.
Yeah.
And the global reaction was swift and pretty negative. Even countries usually friendly to Taiwan expressed concern about messing with global supply chain like that. China, of course, accused them of weaponizing trade.
But it didn't last long, right? They backed down really quickly.
Yeah, just 48 hours later, Taiwan hit pause. They announced a review of the measure. That quick reversal really highlights the tightrope they walk. Trust versus weaponization.
Explain that tension, trust versus weaponization.
Well, think about TSMC. Their whole business model, their main advantage, is being seen as a super reliable, neutral supplier. Everyone trusts them. But the moment you start using that chip supply as a political weapon, even once, you damage that trust. Customers will think, wait, could they cut us off next for some political reason? And they'll immediately start looking for other suppliers. Taiwan clearly realized very quickly that protecting that reputation for reliability is way more important than scoring small diplomatic points.
So what's the fallout for investors looking at TSMC or that whole Asian chip supply chain after this little 48-hour drama?
Well, it definitely adds a new risk factor, right? A geopolitical uncertainty discount, you could call it, when valuing Taiwanese chip companies. And even though it was brief, this incident really underscores the urgent need for supply chain diversification.
Meaning that factories outside Taiwan, like the new TSMC plants in the U.S. and Japan, or what Intel and Samsung are doing, just became even more strategically important.
Absolutely. Their value proposition just went up. The world got a little glimpse of how easily a critical supply could be politicized, and that fear is a powerful driver for investing in alternatives closer to home or in politically stable regions.
Okay, that sets up our final topic perfectly. The U.S. response in this whole trade picture. Let's talk about the Trump administration's new dual tariff strategy. It sounds like it creates a risk of tariff stacking.
Yeah, this strategy shows that protectionism isn't fading away. It's actually getting more complex, more layered. They seem to be running two strategies at the same time.
Okay, what's track one? The broad attack.
Track one is linked to this proposed Reciprocal Trade Act. The goal there seems to be a 10% universal basic tariff on pretty much everything imported into the U.S. Think of it as like a base-level shield for the whole American economy.
Okay, a 10% baseline. And track two is more surgical, more targeted.
Exactly. That's the narrow, deep attack. It uses something called a Section 232 investigation. Section 232 lets the administration slap really high tariffs. We're talking maybe 25% or even higher on specific imports if they decide it's a national security issue. And just recently, on September 24th, they launched these investigations targeting imported robotics, industrial machinery, and medical devices.
Wow. So if you're, say, a German or Japanese company selling industrial robots to the U.S., you could potentially face the 10% basic tariff plus a 25% Section 232 tariff. That's the 35% tariff stacking risk.
That's the potential nightmare scenario, yes.
Oh.
And most experts we looked at see this dual tariff thing not really as the final goal, but as maximum leverage. It's the big stick approach, right?
Yeah.
Designed to push key allies, especially the EU and Japan, who export a lot of this machinery and robotics into negotiating new bilateral trade deals that are more favorable to the U.S. The threat is the policy, aimed to getting a better deal.
So if you're an investor, how do you even begin to navigate this volatility, this stacking risk?
Well, first step is you absolutely have to look at your portfolio. Which companies are exposed to these combined tariffs? Second, brace for volatility. You're likely going to see markets react wildly big drops on tariff threats, sharp jumps when a deal is announced. So probably not a time for excessive leverage.
Makes sense. Where do you even put your money when trading physical goods gets this risky?
The focus shifts, right? You look for sectors that are less tangled up in these physical trade wars. Number one, U.S. domestic companies. Utilities, telecoms, service businesses that operate entirely within the U.S. border. Two, services and intangibles. Think software, media, healthcare services, things tariffs can't easily touch. And three, circling back to our Swiss franc lesson, companies with real pricing power, because they're the ones who can potentially pass those tariff costs along.
And I guess this whole environment makes moving production reshoring back to the U.S. or nearshoring to Mexico or Canada less of a choice and more of a necessity, even for traditional allies.
Absolutely. If companies haven't already started diversifying their supply chains or bringing production closer, they're falling behind. It's becoming a fundamental cost of doing business now, non-negotiable almost, in this global environment. You know, if we pull back and look at all four of these stories, China's concession, the yen's weakness versus the franc, Taiwan's quick Silicon Sword retreat, and this U.S. dual tariff strategy, there's a clear connecting thread, isn't there? The market seems to be valuing structural soundness and trust or reputation much more heavily now than just short-term things like interest rates.
I completely agree. It's like the financial numbers are the score in the game, but the structural strength, that's the quality of the team itself. If a country's economy, like Switzerland's, is built on high-value stuff, or if a company's reputation, like TSMC's, is built on reliability, that seems way more durable in the long run than any single interest rate hike or tariff threat. That feels like the new reality.
That's a great way to put it. Okay, so here's our final thought for you, the listener, to chew on. Given this new U.S. dual tariff strategy, with its stacking risk and heightened geopolitical tension, which specific sector in your portfolio looks most vulnerable right now? Vulnerable to that potential 10% plus 25% tariff hit? And, on the flip side, which purely domestic U.S. sector seems like the safest harbor?
Yeah, some homework before our next deep dive.
Definitely something to think about. We'll talk to you next time.